if you have a severe addiction to heroin, getting off that drug could kill the patient. And we are so addicted to asset bubbles and debt and inflation. Any attempt to actually address that problem is going to cause severe harm, if not an existential crisis.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 9th through February 16th, 2026, while supplies last. First this week, pre-1933 XF Gold $5 Liberty coins are just $89 over melt per coin. Next, 2-ounce silver Canadian Rockies coins are just $6.35 over spot per ounce. And finally, 1-ounce Platinum Nobles are only $170 over spot per ounce. To order our specials or any of the many other options that we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this widely followed returning guest with us. Michael Pento is an active money manager. He's the founder of Pento Portfolio Strategies, and he joins us today as Wednesday, February 11th, 2026. Michael, thank you for coming back on Liberty and Finance.
Thanks for having me back on, Dunnigan.
We'd like your update on the latest indicators that you're watching, which tend to be forward-looking indicators that help you to keep yourself and your clients and us ahead of the curve on the direction that things are taking. What are you noticing right now that is informing you about the trend and where it's headed next?
Well, first of all, we remain in Sector 3 of my IDEC portfolio, 5 sectors that range between deflation and hyperinflation or intractable inflation. Sector 3 is a very investable sector, but again, I want to emphasize how temporary this sector is in. And I want to emphasize as much as I can to you and your audience how fragile the system is. And just like a week ago proved it without a doubt. You saw the crypto market down some 50% from its recent high. Its high was reached in October, down 50% in cryptocurrencies. Silver lost 37% of its value in one day. The tech sector got wiped out. Even just yesterday, we saw major financial institutions like Charles Schwab down 9%, my clearing firm, because of the view that AI would take the place of all tax planning strategies. And there's some tax planning strategies that takes place in Charles Schwab and all the major wirehouses. That's how fragile the system is. The system is out of reserves. So if you look at bank reserves that I monitor every week, they've been drained very precipitously for about a year. If you look at the excess reserves in the system, they're down to about like $1 billion from it was $2.5 trillion in the reverse repo facility. Now it's down to about just a handful of $1 billion in the system. So the system is almost out of reserves. It's very fragile. We are in an extremely precarious bubble, both in credit, real estate, and in equities. I've not wavered on that point for the years that I've been on with you. And we see these iterations when the liquidity in the system comes out, we see these complete fractures. Well, what happened recently is we had Jerome Powell printed $55 billion in just 1 week from January 28th to February 4th. I'm going to get the latest data tomorrow of how much he printed in the previous week. But this shows you that without constant Fed monetization and liquidation of the banking system, the entire economy would fall apart. And again, just look what happened in the past week or so with cryptocurrencies and precious metals and the NASDAQ. Look, here's the point I want to make to you. This is the most salient point. Even though we remain in Sector 3, where it's an investable sector, you need a mixture of stocks and bonds. The system's so fragile that when Kevin Warsh takes office in May and his first meetings on June 17th, if he lives up to the billing of someone who is going to dramatically reduce the scope and size and the footprint of the Federal Reserve, we are in a world of hurt, a world of trouble. It might be a period of time where Main Street wins and Wall Street loses. I pray God that actually happens, Dunnigan.
You know, when you describe a system that's on the edge and basically on life support with these injections of artificial liquidity by the Fed and the drying up of previous pools of liquidity that were supposed to help the banking system stay afloat. It reminds us of times we've seen in the past. Usually these indicators, you're looking forward, but you're looking forward with reference to or informed by what has happened in the past. What has happened in the past in the most important turning points monetarily and economically when we've been at points that look similar to what we're at right now?
Well, when you have, first of all, there's nothing done again that compares to what we have right now. There is no time in history that we've had a triumvirate of bubbles existing concurrently. So if you look back to the NASDAQ bubble, that was it. It was contained within the NASDAQ bubble. Of course, when that burst, it didn't stop the NASDAQ from dropping 83%. S&P dropped 50%. And then you look at the housing bubble. Well, yeah, that was a big problem, but it was mostly concentrated in the housing market. But again, the S&P 500 still dropped over 50%, and home prices dropped 33%. Consequently,
and a lot of people got laid off.
A lot of people lost their jobs too. We can talk about the jobs market in a second. But now you have a massive credit bubble. Look what's happening with AI, where these companies are issuing debt now. It's no longer buying these chips and infrastructure with cash flow. They're doing it with hundreds of billions of dollars in debt. And that investment is really goosing GDP. But make no mistake, the U.S. economy, 80% of the consumers have been in a recession for years. It's just the top 20%, that top quintile, that's keeping aggregate consumption afloat. But when we lose the real estate market, which is, by the way, already, it's down about 20% in parts of Florida already, and the commercial real estate market is still in trouble. Defaults are rising on mortgages. FHAs and Fannie and Freddie are in trouble. FHA secure. Listen, when you have those bubbles burst, real estate, credit, and equities, that 20% is going to join the rest of the bottom 80%. We are going to have a recession like we've never seen before, and most importantly, it's going to be one very difficult to mollify, to ameliorate. And the reason is because this recession is going to be coming when we have an insolvent nation and we haven't dealt with our inflation problem. Do you know that inflation has been above the Fed's 2% target for almost 5 years now? 5 years. Now, this 2% target, it's a target you can go a little bit above it, you can a little bit above it, below it, but it's supposed to average 2%. We haven't been at 2% for 5 years. We've been above that. And we're talking about now QE, and we're talking about lowering interest rates. That's what Wall Street needs and hopes to keep its bubble afloat. That's disgusting that we should even be entertaining that idea. Shame on them.
It was interesting to hear Dr. Judy Shelton, a former advisor to President Trump in his first term, and talking about the original Fed meeting in which this 2% inflation target got discussed and adopted. And the conversation that she related included objections by some saying, why isn't 0%? Why wouldn't we want, if we say that our mandate is for stable prices, why aren't we trying to maintain zero price inflation? And the answer was given, well, it's because people will feel better if they see their paychecks going up, even if they know they're losing ground. My wife and I just got back from a trip, and part of that, a very short, brief part of that, we spent inside a casino. And in that casino, there's that experience, which I've felt at various points when I visited casinos throughout my life, and that is that you're always winning. Every time something good happens, it's almost every time it says, look, you made 16, you made 12, you made 80, you made whatever. Never mind that you when you pushed a button, it did put 400 in or whatever it was. So the idea is you can it makes it look like you're getting ahead, and yet you just get this gnawing, grinding reality that you're falling farther behind. But all of that is just to say that the Fed intentionally, by policy, adopted a policy of destroying people's earnings, savings, and retirements, and they haven't been able to maintain that.
Very well said, Donegan. So the real reason is they have this 2% target. They need an excuse to keep printing money, because when they stop printing money, we just went over what happens, right? So the Treasury has to finance $10 trillion in rollovers and new issuance in this fiscal year. $10 trillion. Now, if China says they're no longer buying our debt, and Europeans, Japanese, Canadians are all, waffling about that idea too, because you can't trust their currency reserves can't be trusted in U.S. dollars anymore because they get confiscated, tariffs, taxes, whatever. Then who's going to buy it? Who's going to buy it? So the answer is that the Treasury needs the Fed to buy it, because if you floated $10 trillion on the public, interest rates would go through the roof. So the Fed has to be a holder and a buyer, removing these treasuries from the public. And what's the excuse that they need to do that? They can't do QT and then also at the same time buy all this debt. So they need to float asset bubbles higher. They need to keep the credit bubble going, the real estate bubble going, the equity bubble going, and they need to print money consistently to take this debt off of the public trading system, out of the public hands. That's the truth. That's why we have an inflation target. It's nothing about Main Street. Now, Kevin Warsh, who I have to give Trump a lot of credit. I don't know if he knows what he was fully doing. I think the reason why Kevin Warsh got the nod to be appointed is because he correctly believes that growth and inflation can exist together. You can have a lot of growth and low inflation, okay? No problem. As a matter of fact, my research over the decades has clearly shown that the highest periods of time when we've had runaway inflation or intractable inflation in this country have been during times when economic growth was low and the unemployment rate was low. So there's a lot of evidence that clearly stipulates that you can have strong growth, high rates of employment, or so a low rate of unemployment, and low inflation. So he correctly understands that. But Kevin Warsh, that's why he got the job, the nomination. Hasn't been appointed. He's been nominated, not appointed yet. But, however, Kevin Warsh is a big advocate for Main Street and not an advocate for Wall Street. He wants to shrink that Fed's balance sheet. He does not want to be a big holder of mortgage-backed securities, and he doesn't want to be a big holder of Treasury bills, notes, and bonds. If that occurs, we're looking at a big problem for the second half of this year. Again, I'm not a Pollyanna. I'm not a perma bear. We've made a lot of money last year for my clients. I'm still, like I said, a sector 3, diversified basket of holdings, including some commodities. I am short the long end of the bond market, though. We can talk about that in a little bit. But my job is to make sure we can participate in bull markets, but protect and profit from what I consider, and I call this the grand reconciliation of asset prices occurs. Because stock prices and home prices have to drop 50% just to get back to a normal relationship to incomes and GDP. And that's what I want to avoid, and that's what I want to profit from. And by the way, let me just say this. It's going to be a healthy reconciliation. Healthy, wonderful for this country. Keep this country viable, a viable middle class, without being, only for the top tier earners.
Right. The best metaphor that I know of this, and maybe you've got a better one, is you've got a patient that is heading towards like an addict who is so dependent on chemicals that he's headed directly down towards death. You're not going to save this guy. And a doctor comes in, new doctor says, we've got to get this guy off of his drugs. No more drugs. We're going to cut this down. We're going to start reducing the dose. And in your heart, that's the only way to save the patient. But you also know it's going to be a heck of withdrawal syndrome that you're going to go through. It's going to affect everybody. It's not going to go quietly. Any other further thoughts from you on that?
Yeah, I do have a further thought. It's not a good one either. So when you have a mild addiction, getting off of heroin is going to be painful, but it's not going to kill the patient. If you have a severe addiction to heroin, getting off that drug could kill the patient. And we are so addicted to asset bubbles and debt and inflation that I think any attempt to actually address that problem is going to cause severe harm, if not an existential crisis. Of course, the alternative is to keep the patient full of heroin, which of course ends up, to translate it back into economics, it's a hyperinflationary crack up, where you just totally dissolve the currency, eviscerate the middle class, wipe out the debt market, and you end up in the same place you were going to be in the first place if you tried to do the right thing. So I have a saying: it's never the wrong time to start doing the right thing. So I hope and pray Kevin Warsh lives up to that billing.
I guess this has been in the circles that I rotate in, which is the preparedness and hard asset aficionados and Mises, Austrian school economics. People talk about, we got to get back to real things. We got to get our feet back on the ground. People have to have know where their food is coming from, know who their neighbors are, have some real skills and real assets that are actually in their hands that they know how to use. The path, we're so far, as you say, we're so far from Kansas right now, off in Neverland or wherever that we've been, that it's going to be people have said, be careful what you ask for. And people say, oh, we want to see $15,000, $20,000 gold, and we want to see $300 silver and all this. As people say, be careful what you ask for, because that will be it will be indicative of acknowledgement. It'll be the truth about very hard times. And those hard times can have spillover effects on breakdowns of societal systems and rights and freedoms and all kinds of things that people take for granted. They think, well, I want to have my cake and eat it too. I want the good life, but I want it to be on a sound footing. It's like the path from that smooth landing from A to B is elusive.
So, $10,000 gold, people think it'll be, how rich they'll be. Gold, one thing about gold is just, it's a placeholder. It maintains your purchasing power. It's not going to make you money. It makes sure you don't get sent off into penury. So I'd be careful about wishing about like exactly you say. If we get $10,000, $15,000 gold, it's because the currency is in free fall and the bond market's is ripped to shreds. But you'll be better off than those who don't own any gold, but you're not going to get rich. Gold is not an investment. It's a stabilizer for your purchasing power. That's what it does. It's not an investment now gold miners are an investment, but the idea is you keep pace with inflation. And that's important during times when there's low interest rates, interest rate repression, and a currency debasement and runaway inflation. I want to touch base on this non-farm payroll report that just came out today. It was released Wednesday because we had that brief government shutdown. With everybody's, on CNBC and Bloomberg, oh, blowout number, it's a blowout number, 130,000 jobs. So what they really should be focusing on is not the initial birth-death model estimate that they really should be highlighting, and in their defense, they have mentioned it, but should be really emphasizing the fact that there were almost 900,000 jobs less, almost 900,000 less jobs created from March of 2025 until March of 2026. So that's the way they do the revision. So on average in 2025, there were just 15,000 jobs per month created with these revisions. You know how you get excited when they say, I can remember so many times last year, it's like, whoa, blowout number. You need to temper your enthusiasm. It's 15,000 jobs. So this is more evidence that this is a jobless, I don't say recovery. We're in a period of very little job growth. You have AI, you have immigration, and you have the fact that the bottom 4 quintiles are really suffering just to make ends meet because of the inflation. So it's not the fact that inflation has gone from increasing by 9% to only increasing by around a little less than 3%, the way they measure it. It's the level of prices has wiped out the middle class of this country. And that's why you see all these sentiment polls telling this is like the worst economy we've seen in decades. It's the level of prices. It doesn't really make them feel better that instead of going up by 9%, they're only going up by 3%. Prices need to fall. The aggregate level of prices needs to drop. It's it's a compounding effect on people who have been overly hurt by inflation. You're compounding by 3% per annum. And I think that 3% number is inaccurate. It's much higher, and it's going to go even higher from there.
I want to give a little illustration of what you just said. So you guys remember when we were kids, you pick up a dime like this on the sidewalk and you think, man, I really found something. And you did, because you could buy like a full-size candy bar, or my favorite was the push-up orange sherbet in a stick. But a dime had real purchasing power. You could make a phone call. Guess what? These same dimes that we sell today, same dimes, are selling for almost $6 a piece right now in the destroyed US dollar. So that gets back to what you were just talking about, the evisceration of the middle class. That's what happened. In every dollar in your savings account went from being able to purchase what's now $6 worth of stuff down to 10 cents. So it's been a 60-to-1 destruction of our purchasing power in our generation. Michael, you've also been looking at the effects on the long bond of the policies and the loss of trust and loss of appetite for the long bond. Our mutual friend, Gregory Mannarino, whom you know well, always has been telling us how much larger the bond market is than the stock market. And rather than people fixating on the stock market, they should keep an eye on the bond market, because that's where he says we're likely to see the first signs of serious developing troubles that are going to erupt and then mess up everybody else, mess up the stock market and the real estate market and everything else. This three-way bubble that you've talked to us about. What's your view currently of the health of the long-term bond market, and where do you see that heading?
Well, Greg Mannarino is a genius because he understands that it's the credit markets that rule everything. So my 20-point model, my inflation, deflation, economic cycle model, is built to detect those arcane indicators that I have, analyzes stress in the credit markets, which always leads to a recession in the economy and an absolute, blow up in the asset bubbles beforehand. So if I can tell beforehand before it reaches a critical mass, what's going on in the credit markets, I can get my investors safely out of what we're now in sector 3 of bonds and stocks. So right now, just to be specific, we own the short end and the middle end of the yield curve, and we are short the long end of the yield curve. So I'm thinking that Treasury yields will rise on the long end and drop on the short end. That's one strategy that I have. I'm also looking to short the high yield bond market too. So that's one way you can profit from the current environment. You want to prepare for what's going to happen probably in the second half of the year, but you don't want to overly prepare for it, because then you're going to miss out on the opportunity, because we're still in a bubble that's expanding. So, but just to make sure I want to stress this point, it's the fracturing of the credit markets that's going to lead to the blow up in the real estate market and the stock market. My model's built to have an early detection system just for that.
People sometimes who are new to this get a little confused when we talk about the interest rates rising on the long end of the curve, and that means the bond prices and values are going down, and that's what's going to be really destructive. Can you help clarify that for people? I know it's clear to people who've been around this a long time, but for those who haven't.
Yeah. So the short end of the bond market is mostly concerned with what the Fed is doing. So if the Fed's going to be cutting interest rates, then the short end of the bond market, the yield will drop and prices will rise. So so when Kevin Warsh comes in, he might be one who will lower the Fed funds rate, but he's going to shrink the Fed's balance sheet. So when you shrink the Fed's balance sheet, that's going to cause chaos in the credit markets. There won't be enough reserves. The repo market will start to fracture, and that'll cause the long end, which is concerned about liquidity, is concerned about inflation, is concerned about solvency. So on the short end, it's in the money market. The money market rates compete with with T-bills, what the Fed is doing. The long end's concerned with inflation, insolvency, and liquidity. And I think, my theory is you're going to see lower short-term rates, prices go up, and bonds yields come down, but you'll see much higher long-term rates. And again, China is not a buyer. Japan can compete with their domestically with their own.
Oh, Michael, don't worry. Grand Cayman will step up and carry the whole load of the world on their shoulders. They've done that. Or Ireland, or Bahamas was it one time?
Yeah,
Go
yeah.
ahead.
So you have that. You have U.S. insolvency. You have our refusal to deal with our inflation problem. That's going to cause long-term rates to continue to rise. And here's the thing I want to mention too. Even if the only thing that could stop that from happening, at least to attenuate that process temporarily, would be some kind of cap they put on and say, okay, the 10-year note just went to 6%, and we are not going to allow interest rates to, kind of like a Mario Draghi thing. We are not going to allow interest rates to go above 6%. We will buy every single benchmark Treasury issue to keep that rate down. Well, think about that. What would that do to the currency? What would that do to inflation? It would be an absolute disaster, and it would only work temporarily, in my opinion.
Well, for one thing, when you say that you need to call in the SWAT team to save your long bond, what does that do to as far as rats leaving the sinking ship of all the other potential buyers of the bond?
You'll have everybody. Listen, the inflation. Let's look at it this way: if inflation goes back to double digits, like it was in right post COVID, 9-10%, actually 17% in reality. What private source would buy a long bond Treasury yielding 6%? No, nobody. You'd be shorting that. So you're committed now you're now buying all the new issuance. You're buying all the rollovers. I'm talking about the Fed here. They're printing $10 trillion a year just to do that. So what does that do to the Fed's balance sheet? What does that do to the bond market? What does that do to the currency market? So, and what does that do to the equity market? That's why this next recession, when deficits go, annual deficits now are around $2 trillion. They're going to go to between $5 and $6 trillion in the next recession. Who's going to buy all that debt? And at what price? That's the question. And the answer is it's going to take a much higher yield to attract private sector buyers. And now you can always say, always add this one final thing I want to add to this, that, okay, the Fed is sensed to buying all Treasury bonds, benchmark Treasury bonds that will yield at less than 6%. So it has to be 6%, the cap on that. Are they also going to cap mortgage-backed securities? Are they also going to cap all corporate bonds? So municipal bonds, where does it end? How much will the Fed print? And what does that do to the world's reserve currency?
Back to our mutual friend, Gregor Manarino, one of his mantras is the Fed will become the lender and buyer of last resort. They'll own it all. And that's the ultimate. My old boss on a previous life said people who criticized China for certain policies that they were doing, like building out cities that had no residents and all kinds of things. He said, you don't understand. They weren't trying necessarily just to stimulate financial progress, or they were trying to keep a 50 million male surplus population busy, because they're solving the equation for a different formula than what you think they are. So yeah, when you look at what you just described, it's like, this makes no sense economically or whatever, to just go head over heels plunging into further and further debt as a country. It's like, wait. We're talking about not an action that's being taken directly by the country. We're talking about a private cabal of international bankers who are buying out, who already pretty much own the majority of assets of a country's balance sheet, and now we're going to buy it all. What does that mean about the freedom and independence of our country? And I don't know. I know you have limited time, so we can't go plunging too far down that road. But any further thoughts from you about the freedom and independence?
The independence of the central bank of the United States is under attack. I mean, that's not my theory. That's not a subjective opinion. That's just a fact. So the Fed is going to be forced to monetize trillions and trillions of dollars of government debt. That's just the way it is. And the only thing they can do is continue to do that until we have a real problem where inflation is so high that the alternative of having a a cathartic depression for a truncated period of time is better than the existence of taking wheelbarrows full of dollars and trying to buy a loaf of bread. That's I would never think that. It sounds like such hyperbole, but who would have ever thought? And I've had conversations with very high up officials at the Federal Reserve back in the 2000s. It was anathema to them that the Federal Reserve would ever print trillions of dollars. And the entire Fed's balance sheet in 2007 was about $800 billion, $800 billion. And it went to $9 trillion in the space of 4 years. So, what you would previously think as unthinkable becomes reality. And like you said, this is a cabal of individuals who, if they just were worried about stable prices and protecting the value of the purchasing power and living standards of the middle class of this country, their inflation target would be 0, it wouldn't be 2, and it certainly wouldn't be missing that target to the north for 5 years and be talking about a return to QE, which is exactly where we are. And the reason is to keep asset bubbles from crumbling. Like I mentioned last week, they were crumbling all across the board. Everything goes to a correlation, the R squared is 1. Everything gets sold to go into dollars and to go into cash. Unfortunately, that's where we are in this country.
Michael, for people who want to take advantage of your continuous work to keep ahead of these trends that continually change as we move forward, how should they get connected with you?
So the website is pentoport.com, and I have a midweek reality check there. It's $50 a year, the 5-week free trial, and I'll give you my 36,000 foot view of what's going on with the economic data that you really need to know, not the headline blowout non-farm payroll number, but the fact that we actually reduced the number of jobs by like almost 900,000 last year. So, and also if you are a U.S. citizen and you qualify for a long-short portfolio, I will take you and manage your money yourself by myself in the inflation deflation economic cycle model. My team will do that. Me and my team will do that.
Michael, we're always grateful for your presence here. And folks, you won't miss a single episode with Michael or any of our other guests if you're on our free mailing list. Just go to libertyandfinance.com, all spelled out, all one word, libertyandfinance.com. Put in your email address, click submit. Make sure you confirm on the confirming email. You'll get 1 email in your inbox per day. It'll have all our interviews with Michael, all our other guests, and any weekly specials. You won't miss a thing. Michael, just on behalf of all of our viewers and subscribers, thank you again for joining us here on Liberty and Finance.
It's always a pleasure, Damian.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for February 9th through February 16th, 2026, while supplies last. First this week, pre-1933 XF Gold $5 Liberty coins are just $89 over melt per coin. Next, 2-ounce silver Canadian Rockies coins are just $6.35 over spot per ounce. And finally, 1-ounce Platinum Nobles are only $170 over spot per ounce. To order our specials or any of the many other options that we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.